War, rate hikes, crashing cryptos, and sinking stocks. That is the beginning of Jeff Clark's latest article, Gold and Silver in 2022. And toward the end of the article, it also gives us what to watch for in 2023. And the first part of this article deals with the performance of all of the different major sectors in the final quarter of 2022. And so for the last quarter, silver was by far the biggest performer, followed by the Dow, gold, the S&P, and real estate. Inflation, I don't know if you can consider that performance if it's on the positive side, but you can see 10-year Treasury, NASDAQ, crude oil, dollar index, and commodities all down. Going into looking at, I like longer time frames. So when we look at all of 2022, it gives us a much better perspective of what's been happening. The US dollar index was up 8.2%. Now, I want to remind everybody that that doesn't mean the dollar was up 8.2%. It was up 8.2% compared to other currencies that it was being measured against. In other words, the other currencies fell 8.2% faster than the dollar because if the dollar was up 8.2%, that would mean prices would be down 8.2%. So it is not the dollar rising in purchasing power. The dollar is losing purchasing power. It's just not losing purchasing power as quickly as all of the other national fiat currencies. If we used money instead of currencies, we would not be suffering this problem. Crude oil was the next best performer, followed by silver and gold. And boy, is gold doing its job. It is protecting people from losses because look at this. Commodities down almost 9%. The Dow down almost 9%. 10-year treasuries down almost 17%. S&P down almost 20%. Real estate down almost, it's down 27.5%. And the NASDAQ down by a third, 33%. So it has been a bad year for most asset categories except for gold, silver, and crude oil. And, you know, one of the best decisions I ever made was getting into precious metals. We'll show you that at the end of this video. By the way, we'd like to know if you'd like to see 2 shorter videos per week or one video that's a little bit more in-depth. So that's a poll we're going to put out there. Let us know. Sometimes the short videos are harder to put together than the long videos. Then we go down to meanwhile, stocks took it on the chin, one of their ugliest years in modern times. According to Bank of America, the annual return on the conventional 60-40 portfolio was the worst in the past 100 years. Now, that's possible if you're looking at it annually, because I think probably the worst performance you're going to find is if you created a fiscal year that was end of September. You'd find that October, November, and December of 29, and then January through September of 1930 was probably worse. But this is saying something, that Bank of America is saying that it's the worst annual return. So they're talking about an end of December return in the past 100 years, including the 1929 stock market crash and the beginning of the Great Depression. Wall Street Journal reported that a basket of U.S. Treasuries, highly rated corporate bonds, and mortgage-backed securities was down more than 12% in 2022, its worst year since 1975. Now, this bothered me because I don't even remember mortgage-backed securities existing in 1975. And so I did a little bit of research on it, so I'm going to take a little side tangent here. I went and did some research on the history of mortgage-backed securities. And when you get down to the history, you know, the groundwork for this has been laid for a few hundred years here. We're talking about the 18th century, and it's got a very dark beginning with slave mortgage bonds of the early 18th century. This is just a horrible foundation to create a financial product on. But the foundation was strengthened during the Great Depression with the Glass-Steagall Act and the New Deal and the creation of the Federal Housing Administration, National Housing Act, Fannie Mae and Freddie Mac. And then we get to securitization. This is where it is turned into a financial product that can be traded. Ginnie Mae guaranteed the first mortgage pass-through security of an approved lender in 1968. In 71, Freddie Mac issued the first mortgage pass-through called a participation certificate. It was not a mortgage-backed security yet. In 1981, Fannie Mae issued the first mortgage pass-through called a mortgage-backed security. So it was 81 that it was created, not 75. But it's when you get way down here toward the end of the history, this Graham-Leach-Bliley Act was signed into law in 1999, allowing in-house creation sold by banking institutions of mortgage-backed securities as an investment and derivative investments. So that means that it wasn't until this century, really, that the mortgage-backed security was something that was out there and being actively traded. It was harder to acquire an investment in mortgage debt before that. It became easy and became something that you could buy and sell on a trading platform as of this century. So it surprised me that the Wall Street Journal had reported that a basket of these treasuries, bonds, and mortgage-backed securities was down more than 12% since 1975. I don't think the Wall Street Journal nor Bank of America has done their research that well, but this is quoting them. Morningstar says the average U.S. stock fund was down roughly 17%, value funds down 6%, growth funds down nearly 30%. The percentage of trading days in the S&P 500 that registered losses of 1% or more was 24%, the worst year since 2008. Now, this tells you something. It tells you where 2023 is being set up for, where it's going. 2022 was the worst year since 2008. I think you're going to find that 2023 is probably going to surpass 2008. The MCI All Country World Index fell more than 20% since 2008, also the worst since 2008. The Wall Street Journal reported that U.S. government bonds suffered the biggest annual decline in history. Now, this isn't surprising, considering if you look at my video from last week and the two that were at the end of last year, the Fed is raising rates at this reckless pace that is the fastest in history. Therefore, the decline in bonds, rate is the inverse of price. And so if you raise rates that quickly, you're going to have a fall in bond prices that quickly. So if you're invested in bonds and you want to sell your bonds, you're taking an enormous hit when the Fed does something like this. And it has really become very, very obvious that they are going to, Elon Musk said that the Fed is deciding what they're going to do. They're driving a car by looking in the rearview mirror. And it's not just looking in the rearview mirror. It's looking in the rearview mirror of a video that was made 3 months ago. So they're making plans based on outdated, irrelevant information. I've been doing this now for many, many years. Writing and commenting on this for, it's getting close to 20 years now. And I've really come to the conclusion that these are very highly educated morons. They just do not have a clue as to what they're doing. They overcorrect and undercorrect. They cause bubbles and then they pop the bubble. And that is what we're going through now. And I believe what you're going to see happen, we probably will see 0% interest rates again when they create the next major disaster. it will most likely be bigger than 2008, because the bubbles that that was just a real estate bubble and a minor stock market bubble. But now we've got massive real estate, stock, and bond market bubbles. And when they pop these bubbles this time, so far, we have seen them deflate. But there will come a day, probably this year, probably pretty soon, I have no idea, but when they pop these bubbles, and then they start reacting to this emergency that they created, and they're going to be pulling every lever and pushing every button. There will be QE5, basically, just printing to infinity, and the QE forever basically has never ended yet. They're talking tough, and there's tricks that they use to hide stuff on the balance sheets. Look at the definitions of reverse repurchase agreements, and it's accounted for a bit differently than what it is actually doing in the currency supply. Anyway, getting back to this, revenue for investment banks posted a 40% decline in 2022. Oh, the biggest decline on record, even worse than 2008. Now, that should really tell you something of where things are going to be going in 2023. Now, this was a decline in revenues. It doesn't mean they're making a loss. It's 40% less profits than the previous year, less revenue. So, the 2023 watch list. The start of the new year begins not as a blank slate, but with a myriad of volatile factors. And boy, I would have to agree. Wait until you read my upcoming book. It should be out very shortly. Inflation, the Fed claimed in the spring of 2021 that it was going to be transitory. Well, we have to, I guess, the government, the Federal Reserve, the economics books are going to have to redefine what transitory means, just like they're doing with everything else to make it fit whatever their narrative is. But 20 months later, CPI is still 7.1%, although it's down from its peak of 9.1%. Now, this was caused because the Federal Reserve inflated the currency supply by 40%. It's not all of these other factors that they're blaming. These are triggers, and they cause short-term movements. But that, if you've got a certain amount of goods and services, and you've got a certain amount of currency that you can buy and sell those goods and services with, so you're busy producing, buying, and selling these goods and services with this amount of currency over here, and you increase the amount of currency, you didn't increase the amount of goods and services available by 40%. So if you've diluted the currency supply, the value of each unit has to sink by that amount that you've increased the currency supply by, because it is the thing that is being used to buy and sell the real wealth, the goods and services that exist. So the Fed's 2% CPI goal is clearly off. And if you watch my 2 videos from the end of last year, it shows that we have come down from deflating bubbles before, where we got into a bubble and it didn't burst. There wasn't a major economic crisis and crash. And by putting up with inflation, which is difficult on everybody, and I get no benefit from saying this, but the Fed should be targeting like 6% inflation or something like that until they can suck up the rest of this currency supply. And then instead of raising rates dramatically, start raising lending standards to slow down the creation of currency growth, but do it very, very carefully, because we are in we're just coming off of the biggest bubbles in history. And if they pop, if they suddenly burst and we have crashes in real estate, bonds, and stocks, it's going to be a major financial disaster, such as the world has never seen. So the IMF reported that global inflation ended 22 at almost 8.8%, and almost double 2021. Sees average for the world around 6.5%. If the Fed can allow the rest of the economy and all of the other things in society to catch up to the bubbles that it created, it won't burst. They won't have an economic disaster, a crisis on their hands. But they're not going to do that. They're just going to continue to raise rates until they create the greatest crisis in history. And to me, the only way out that I see, the only way to protect yourself, is precious metals and probably farmland. I have no idea what cryptos are going to do during this crisis. I do have a good idea of what stocks and bonds and real estate are going to do during this crisis. I pretty much know what gold and silver are going to do. They're going to do what they've always done throughout history. And they're going to do an accounting of all this excess currency that has been created. So let's go on with this. CPI is easing. So will the Fed pivot? Yes, the Fed will pivot once they have totally destroyed the economy. I'm sorry, I just can't believe how stupid they are. They're going to cause a crisis. They will slam rates back down to zero, and they will start creating currency at a rate, I'm going to paraphrase Jim Rogers, because he called it money. And it's not money. They can't print money. They can print currency. They can't print money. But Jim Rogers said they're going to print money, so I'm going to paraphrase it. They're going to print currency until they run out of trees. And this is probably what will happen. This is probably what will happen in 2023 through 2025. I'll show you later in the video how the performance of how I've been protecting myself against what everybody else is attracted to. So moving on, recessions. The global yield curve inverted for the first time ever. So global yield curve. Now, I didn't study that one very much. I don't know what data set the global yield curve comes from. But the 10-year minus the 2-year US curve, that's the standard. But it's only one of a whole bunch of different indicators. So if you look at my video that was before Christmas, you'll see the warning to the Fed. The last video of last year is the one. It's when will it hit the fan? And that one shows you the timing of this because the 10 minus the 2 says that sometime in the next year and a half or two, there's going to be a recession. But then there's a whole bunch of other indicators, and now they're all lined up for us to be in a recession now, or a recession to start very shortly. The US dollar was up 20% through October. Okay, this is the US dollar index. Always, when people say the dollar is going up or rising, you need to correct them and say, well, no, the dollar index is rising, meaning measured against the basket of currencies that are in this US dollar index. The US dollar is falling at a slower rate than the rest. The rest are falling faster. And so, but if it's going up, that means prices go down, period. The US dollar is not going up, it's the US dollar index. Real estate, home sales fell 35%. Oh, OMG. New listings slumped 28%. So this is huge. These bubbles are rolling over. But real estate still has to come down by about half, according to Robert Shiller's index, going back to, I believe, 1886. And he has them inflation adjusted. So to get in balance with the rest of the economy, in balance with the goods and service, the prices of the goods and services out there, in balance with the mortgage rent ratio, the mortgage average income ratio, all of these things that you can measure. People can only spend a certain amount of their income on putting a roof over their head throughout the centuries, but it bounces up and down. And we've come off of this insane bubble that is the highest in history. And now it's deflating but it still has, real estate has to fall by about half from where it is to get in balance with the rest of the economy. So the stock market, bond vulnerability, we have to watch out for all these things. Resumption of QE. That is probably not going to happen until they create the next disaster. And meanwhile, President Biden signed a $1.66 trillion funding for the U.S. government for fiscal year 2023. We've created the Inflation Creation Act, that the Inflation Acceleration Act, that is going to make things worse. How they think they can spend their way out of this problem is just absolutely beyond me. Central banks bought more gold in Q3 than any time since when we were on the Bretton Woods gold standard. This is very telling, and when you look at what central banks are buying, it's the central banks in the East. It's China, it's Russia, it's all of these, Turkey and Iran and all of these countries. And China has been chiseling away, whittling away at the U.S. dollar for a long, long time. There will come a day. Right now, the U.S. dollar is the only choice that the world has. So it's in a very good position. But the end of the global dollar standard is within sight now, because you've got countries trying to get around, actively creating means of getting around using US dollars. China, Russia, the BRICS countries, and so on. Is this a perma-crisis that we're going into? This is a new word that was added in 2022 from the Collins Dictionary, referring to an extended period of instability and insecurity. And I do believe it is. But your best security, this is the World Gold Council's Gold Hub, and they've got these great tools. I've shown you this once before. I've picked 1 year here, December 2021 through December 2022, to analyze. And they put it with this bizarre mix of a whole bunch of stuff as a default. So you've got to go and change this. But I made it into the standard 60% stocks, 40% bonds portfolio. And then I did the same thing, but I added 10% gold, which a lot of people will recommend, even in the gold industry. For some people, for some reason, people will say, put 10% gold, but no more, because gold is dangerous. And then I did my portfolio, which, I used to say, I'm fully diversified. I've got both gold and silver. And so I just went 100% gold because they don't have silver in here as an asset class. I've never really clicked this. I'll try it next time I present this. But then you click Analyze Portfolio, and you come up with the results. And there are the balances of the three portfolios. And I don't have any, well, I do have some stocks now, but very few. I'm betting on a bright future after a very, very dark period of time. So I've got a little bit of stocks that I bought with what I called gambling currency. It's the currency you take to the roulette table or the blackjack table in Las Vegas. And by the way, I ran a business in Las Vegas for years. I've been to a lot of the casinos. I don't gamble. Your odds are much better starting a business. So that is what I did. That's where I placed my bets. So this is that same portfolio with the 10% gold allocation, and here's all gold. And here is the performance over a year. If you put $100,000 in, the gold is at just over 100,000, and the other two portfolios have lost a little bit more than 15 and 17% respectively. Now, if you take this and go for the entire century, so this is where I have been. I've been on this one, precious metals, for the entire century, and you look at this performance here. Now you have gold more than doubling the performance of the S&P 500. The 60/40, the recommended U.S. stock market, U.S. Treasury market, that 60/40 mix. Gold outperformed it by more than double. So Jeff Clark's article is on GoldSilver.com, and my videos, go to my YouTube channel and watch When Does It Hit, and the soft landing and warning to the Fed video. Thanks very much. We'll see you next time.